Hey, what's going on, guys? It's Marcos. In this video, I'm going to be showing you exactly how to qualify for a home loan if you are self-employed and you can show your tax returns. And there will be a couple of main reasons as to why you don't want to show your tax returns. Primarily, one, you haven't filed your taxes. Happens a lot if you're self-employed. Or two, maybe you just don't really declare enough net income on your tax returns, and you've had already a mortgage banker already tell you that you just don't show enough income on your taxes. So there are certain programs that will be geared for you that are not necessarily through kind of like the government loans, like a conventional mortgage or an FHA. These are really just private mortgages that are available for people who are primarily self-employed. All right, so let's go ahead and cue this slide right now and let's talk about exactly who these loans are for, because they are really beneficial, and unfortunately just many people just don't know about them. Okay, all right, so number one, you are self-employed, strictly self-employed. All right, if you have a W-2, you're an employee of a company, this is not for you. This is self-employed only. You're a business owner, you're an entrepreneur, you're a contractor, a consultant, you get a 1099, or you have a K-1, or you got a corporation, this is for you. Number two, this is not a first-time home buyer loan. As a matter of fact, these programs are not for people who are buying a home for the first time. You have had to show that you have owned a home in the past, at least in the last 3 years. However, there may be some considerations if you're a first-time home buyer, but I don't really recommend these programs for a first-time home buyer. Number three, you have assets. Minimum down payment for these loans is 10%. I'm going to go ahead and run through a couple of examples here for you. However, I do recommend at least a 20% down payment on these programs. Also, these lenders are going to want to see some reserves, and primarily about 6 months in reserves for these kind of programs. Okay, so this is not really for somebody who's looking for a low down payment or a no down payment loan. All right. Number four, really, you just can't qualify for anything else. You've tried doing the conventional loan route, the FHA route, and they just told you don't qualify because literally, guys, I mean, it's better to go and get one of those programs if you can qualify than these. These are just as a sort of last resource, okay? You just couldn't get anything else. And unfortunately, well, they deny you, and this is your last resource. All right, guys, now let's go ahead and jump into the computer, and I'm going to show you some requirements from these lenders, and also we're going to run through a couple of quick scenarios so that you can understand a little bit about what are some of the things that you need to have in order to qualify for one of these loans. All right, so the lender I'm going to be looking at is called Angel Oak Mortgage Solutions, and these guys are probably one of the biggest non-QM loan lenders in the country. By the way, these programs are called non-QM, basically meaning that they're non-qualified mortgages, which means that they are not backed by the government. Okay, so most people just understand mortgages as far as the conventional loans or the FHA, VAs, and that kind of stuff. These are not those kind of loans. All right, so don't expect the same things. Don't expect the same underwriting guidelines. Don't expect the same interest rates. These are completely different loans. All right, this company really just they only focus on these non-QM loans, and this is the bank statement mortgage program, which, by the way, is either a 12-month bank statement program or a 24-month bank statement program. The difference is going to be on the interest rate. By the way, these rates are going to be higher than what you would pay on a regular mortgage because, once again, they're a little bit more risky, and these are not backed by the government. So obviously you're going to be paying a little bit more on interest rates. But anyways, let's go ahead and run through some of the things that they require and some of the key benefits. Okay. First one, loans up to $3 million with a minimum of $150,000, 12 or 24 month bank statements, only 4-year seasoning for foreclosure, short sale, bankruptcies, or deed in lieu, 30-year fixed rates. You got to be self-employed for 2 years. Okay. You gotta own at least 25% of the business, but that's the minimum requirement for business ownership. You can do a purchase loan, or you can do a cash out refinance or a regular refinance. Owner occupied property, second homes, or non-occupied, meaning rental properties. You can do it with a 1099. We're gonna look at this one in a minute. Also, something really cool, 40-year fixed interest rates only, interest only available. That's crazy. Okay, we haven't seen this in a long time. So if you want to have the lowest payment, you look at something like this. Again, a regular mortgage loan does not have any of this kind of stuff. Non-warrantable condos. So if you don't know what a non-warrantable condo is, it means it's a condo that doesn't qualify for the regular conventional loans. All right. And finally, credit score starting from 640, and they go up to 90% loan to value with no mortgage insurance. So it's pretty cool. Okay. No mortgage insurance, even though you're putting down just 10%. However, I do recommend you guys to do at least a 20% down because it's going to help you with the interest rate. Now let's go ahead and take a look at a simulator where it's going to show us what kind of interest rate you can expect, and we can kind of get an idea as far as a monthly payment goes on this. Okay, now let's go ahead and jump over here on the computer once again. Let's put a loan amount of $400,000 to make things easy, and we have a 640 to 659 credit score and a loan to value of 90%. So let's make sure that we have the right program. So this is a purchase and no full doc. We're actually going to do the 24-month bank statement. Okay, so on this one, it looks like for a credit score between 640 and 659, they need 20% down. So let's see what happens if we go ahead and make it a 700 credit score. All right, so we get a 90% loan to value, which means you just need a 10% down payment for this. Par interest rate will be 6%. So see guys, I'm telling you, these loans are not like a regular conventional loans. So you're paying on the interest rate, of course. So 6% on this, and that's on a 45-day lock and with a 6-month reserve requirement. So if you have a monthly payment of say $3,000 a month, then you gotta have $18,000 in addition to your down payment, but that's only going to be for reserves. That's not really for, money that you need to put down. It's just reserve requirement. So that's the 24-month bank statement program. Let's see if, kind of what it says about the 12-month. So on 12 months, the interest rate goes up to 6.375. So if you guys can show 24 months of bank statements, then it's a lot better because that's 3/8 of a point. That could be significant amount of money on these deals. All right, so now let's go ahead and take a look at the 1099 program, which basically is if you're a contractor and you get a 1099, then this will be a really good loan for you. So we have a maximum loan to value of 90% with a 700 credit score. So you need at least 700 to qualify for that 90% and 20% down with a 640 credit score. It's sort of basically the same thing as the last one that I just showed you, 3 million, up to 3 million with a minimum loan of 150. No tax returns required. That's really key. That's why we're, doing this video right now. You need one most recent 1 or 2 year 1099 plus year-to-date earnings statement allowed. So that's very easy to get if you're 1099. You need a year-to-date earnings verified from earnings statements, pay stubs, or bank statements. That's also pretty easy. You may also be able to get your CPA to write you a year-to-date earnings, like a profit and loss. 1099 has to be only from one employer. So if you have multiple 1099s, this wouldn't be for you. You just need one 1099 only. And obviously 2 years of showing the 1099 income, owner occupied property, second homes, non-owner occupied. So that's a rental property, purchase and cash out in term, rate in term refinance. And same thing, 4-year seasoning for foreclosure, short sales, and bankruptcies. So once again, we got 640 minimum credit score, and obviously that's going to get you that 20% down. But if you get your credit scores to a 700, then you could do the 10% down payment with no mortgage insurance. All right, so there you guys have it. So this is just one lender that we are just exploring. Now there are multiple lenders out there, and really the easiest thing that you can do is just to Google non-QM mortgage lenders in your area. Very easy. And then just basically, if this is your situation and you already know kind of what to expect, you really can't qualify for any of the other loans, then really this would be a good option for you. Before wrapping up the video, I want to review some of the cons about the program because there are some things that you definitely need to know before getting into one of these deals. The first one is expect higher interest rates. Okay, now we just went through a simulator and we priced out an interest rate of 6%. So literally, if you can't get a regular conventional loan, that's going to be your most cost efficient thing. This is your last resource. These rates are going to be higher. Yes, you can get a lower interest rate by either buying down points or by putting more money towards your down payment. So if you have 30-40% down payment, you might see an interest rate starting at 5%, which is still much higher than what's available out there on a regular conventional mortgage. The second thing that I have against the program, or some of the cons, is definitely there are going to be some higher fees. So, there's going to be origination fees, processing fees, underwriting fees, and they can be a lot higher than you can expect on a regular mortgage. These fees can range anywhere between 1.5 to 2.5% of your loan amount. Now, the third biggest downside that I see with these kind of loans that you definitely need to know is that it has a prepayment penalty, and the prepayment penalty is for the first 3 years. So if you either pay off the loan in full, you refinance, or you sell the house within 3 years, you are going to have a prepayment penalty, and every prepayment penalty is actually going to be different. So make sure that you talk to your mortgage lender about these kind of loans. All right, there you guys have it. Hopefully the video was helpful for you to understand about the self-employed bank statement program. And now you probably see now there's some upside to it. There's also some downside risk to it as well. So make sure that this actually fits your own personal situation. If you guys liked the video, make sure you give it a thumbs up. Subscribe to the channel. Definitely helps the whole YouTube algorithm. Spread the word on homeownership, and let me know what you think about it in the comment box below. If you are going through a program kind of similar to this, or if you are having issues, just basically getting qualified for a regular mortgage, just put it in the comment box below. Give me some feedback, and I will see you guys on the next video. Thank you for watching.